While Robert is away, here's the best of Jim Rickards, his top insights on the economy, the Fed, gold, and preparing for what's ahead.
You said the new Great Depression. Are we in a new Great Depression?
We are. And by the way, thank you for mentioning my last book, Aftermath. And if you have a copy of Aftermath handy, go to pages 288 to 291. Now, this book came out in July 2019. In those pages, I say there'll be a pandemic in the next 3 years, and there'll be social disorder and riots in the streets.
Oh, it's your fault. It's your fault. We knew it was.
Well, anyone who read that book can't say they weren't warned. So again, read the whole book by all means. But
look, Jim, can I say one more thing? In the book, The Road to Ruin, you warned also that there are military vehicles stationed all around America getting ready for the riots.
Sure, and they we were even closer with the book Aftermath. So everything we're seeing now was in that book. But Kim, to your point, the title of the book is The New Great Depression: Winners and Losers in a Post-Pandemic World. A lot of people don't know what a depression is because they, first of all, no one's ever lived through it. If you have a living memory of a U.S. depression, you are 90 years old. And my mother's 90, so she remembers it. We still talk about it, but you're 90 or older if you remember the depression. So very, very few people in that category. Most people have never lived through a depression. They don't know what it is. They assume must be a continuous declining GDP. It's not. Two quarters of GDP, of declining GDP, is the technical definition of a recession. But a depression means depressed growth. You can have growth in a depression. It's just the growth is below potential. So if your potential is 3.5%, and your actual growth is 1.75%, that gap between, say, 3.5 and 1.75, that gap is depressed growth. Now, if your debt is going up 5, 6, 7, 8% a year, which it is, and if your growth is 1.5, 2% a year, which it is, which it will be in my forecast, then your debt to GDP ratio, when your debt's going up faster than your income, you're going broke. It's as simple as that. So, but people aren't. We're looking at intergenerational changes, and again, it all comes out of the COVID pandemic. But the pandemic, the social unrest, and the depression, it all converged in 2020. But a lot of people don't know the stock market reached a certain level in 1929. Do you know when it crashed 90%? Do you know when it regained the 1929 level, when it got back to the 1929 level? 1954. It took 25 years to get back to where it was in 1929.
The Dow hit 381, and it took till 1954 to hit 381 again.
Correct.
Yeah.
But so it went down to about 30. I remind people that Joseph P. Kennedy became one of the richest men in America by shorting stocks ahead of the Great Depression. So you can make money in depressions. You just have to see it coming.
Yeah. Anyway, the last question is the debate between inflation and deflation. And I don't know if you pay attention to Peter Schiff, but his definition of inflation and deflation are different than your definition of inflation and deflation. And so the question is, are we heading for wheelbarrow money, where it takes a wheelbarrow of money to buy a loaf of bread? Or are we, what else are we going into? So
we're probably, I had a debate with Peter on this recently. He kind of reminded me of I forget the character, the Mad Hatter, maybe from Alice in Wonderland. I said, words mean exactly what I say, no more, no less. Peter has a definition of inflation that may work for him, but it doesn't work for the Federal Reserve, the European Central Bank, the United States Treasury, or anybody who's trying to figure things out. So I use consumer price inflation. I mean, just to be a little technical, the Fed uses something called personal consumption expenditure deflator year over year. That's a technical name, but it's basically just their personal core, by the way, core PC deflator year. It's just their personal definition of inflation. That's the one I use. It doesn't matter if I agree with it or not. If I'm trying to figure out the Fed and the markets, I better use the same tools the Fed is using, or else I'm going to miss it. Money supply has nothing to do with inflation. Inflation is caused by velocity, which is the turnover of money. So let's just say you took the money supply from $4 trillion to $7 trillion. Nominal GDP is money supply times velocity. This is just the quantity theory of money. This is Milton Friedman's famous equation, which actually goes back to Irving Fisher in the 1920s. Well, they took the money supply to 7 trillion. Okay, what's 7 trillion times zero? It's zero. In other words, if you don't have velocity, you don't have an economy. The thing that drives inflation is not the money supply, it's the turnover of money. That's the velocity. That's the zero in my case. Velocity has been dropping since 1998. It didn't start in 2008. It didn't start in 2020. It's been dropping like a stone since 1998. And it's getting closer to zero. So
wait, Jim, what does velocity mean for the average?
Velocity is the turnover of money. So let me give you a very simple example. So let's say I go out for dinner and I tip the waiter. And the waiter takes my tip and she takes the taxi cab home and tips the taxi driver. And the taxi driver takes the tip and fills up his car with gasoline, okay? In that example, my dollar had velocity of 3. There was the waiter tip, the taxi driver tip, and the gasoline. So my dollar supported $3 of goods and services. So that's velocity of 3. What if I stay home and watch TV and don't spend any money? The velocity is 0.
Velocity.
In other words, that's the point. It's not how much money you print. It's whether people are lending and spending, and they're not. And it's psychological, and the Fed cannot control the psychology. And you've got to change the psychology, get out of that deflationary problem, which, by the way, the only guy who did it successfully was Franklin Delano Roosevelt in 1933. And how did he do it? He raised the price of gold.
So they're sitting on it. They're not.
Correct.
They're not spending it.
Well, you're right. You're absolutely right, Kim. It's in the data. The personal savings rate. So savings rates have tripled or quadrupled. And that is what's actually happening. Those are Chinese levels of savings. So people are not spending the money. And they do, if they write a check, they're paying off debt. They're not using it for consumption.
So the final question to you is when I buy gold and silver, the velocity stops?
Yeah, because I'll speak for myself. You buy gold, you put it in a vault, and you sit on it. Well, I'm not spending the money.
That causes deflation.
First of all, it has to do with the definition of a depression. And most people don't have a good definition of depression, and economists don't even use what I call the D word. They don't like it because let's compare it to recession, the R word, okay? So recession is well defined. It's two or more, or at least 2 consecutive quarters of declining GDP. There are a couple other bells and whistles about employment, and there's a referee, the National Bureau of Economic Research, a private, econ think tank in Cambridge, Massachusetts. They call the balls and strikes. They tell you when a recession begins and when it ends, when the expansion ends, et cetera. So, but two or more consecutive quarters of declining GDP. That's the classic definition of a recession. So people go, depression sounds worse than recession. And if recession is 2 quarters of declining GDP, a depression must be 10 quarters of declining GDP. It must be way worse. And that's not the definition of a depression. First of all, 10 quarters of declining GDP has never happened. If it did, we'd all be in trouble. But maybe during the Great Depression to some extent, but not otherwise. But that's not the definition of a depression. Depression means depressed growth, meaning you can have growth in a depression, but the growth is depressed relative to trend, relative to potential. So in other words, if your economy, if the long-term trend of recovery growth in a recovery is 3.5%, which it is, and you're growing at 2%, which we were for 10 years, that's depressed growth. You're creating a wedge. So here's the 3% trend line, and here's the 2% actual growth. Well, in between those 2 lines, that's depressed growth. That's lost output. You could have been here, but you're actually here. And because it's a wedge, guess what? Over time, it gets bigger. I would say we've been in a depression since 2007, that the entire so-called recovery from 2009 to 2019, it was a 10-year recovery, the longest recovery in U.S. history, but it was also the weakest recovery in 10-year history. The average annual growth for that 10-year period was 2.2%. But for all post-1980 recoveries, average growth was 3.2%. And if you go back to post-World War II recoveries, it's closer to 4%. So if you have an economy that can grow 3-4% and you're growing at about 2%, that 1% is, 1%, what's the big deal? Sorry, 1% of 20 trillion compounded for 10 years is a big number. You're talking about trillions of dollars of lost wealth, lost output, and from the government's perspective, lost taxes. So that is the definition of a depression. John Maynard Keynes defined it that way. It was good enough for Keynes, it's good enough for me. If I want a gold standard, I can't peg it at 1,800 because I'd have to cut the money supply by 3/4 or more. So what's the alternative? Raise the price of gold. So notice the same amount of gold can support any amount of commerce at a higher price. So then the question is just an eighth grade math problem. It's like, okay, well, what would the price have to be to match the money supply? And use M1 as an example. And I assume 40% gold backing. You know, the Austrians and the monetarists, they bang the table. No, it has to be 100%, or, you know, you're levered. Okay, that's a debate for another day. So I'll be conservative and say 40%. So if you take 40% of the money supply, and that's how much gold you need by value, and we know the weight, divide one by the other, and you come out to $15,000 an ounce. So the reason I'm explaining that, Robert, is I want to be clear that there's not a central bank in the world who wants a gold standard. They're not going to go to it voluntarily. Correct. But if they have to, because of collapsing confidence in the dollar, then it follows that you have to go to $15,000 an ounce, because any lower valuation is deflationary, and that's the last thing you want.
There have been three Feds. The greatest prosperity was between the second and third Fed. And why do we have the third Fed?
Right. Well, you can say we had three Feds. We actually had three central banks, but one of them was called the Fed because they didn't want people to know. But there was a reason for that, Robert. You make a good point, because they didn't want people to know it was a central bank. Yes, the Fed is our third try. The first bank of the United States, I think it was kind of 1797 to 1816. It had a 20-year charter, so it went from the late 1790s to around 1814, give or take. And then they shut it down. They said, well, we don't need this. This is concentrating all the, it was actually based in Philadelphia, concentrated too much power in Philadelphia, the Eastern merchants and all that. So they let the charter expire. Well, then we got, then it was kind of a hangover from the War of 1812, and we needed finance, and trade was disrupted, et cetera. So they, I guess the first bank ended around 1812. But then after the war, we needed a new one. So they chartered a new one in 1816. And that was called the Second Bank of the United States, also a central bank on, I think, Chestnut Street in Philadelphia. The building's still there. It's a beautiful old building. Now, that was a 20-year charter also, so it ran until 1836. Well, guess who was president in 1836? Andrew Jackson. And he hated the central banks. And he came from Tennessee. He campaigned to shut down the central banks. Well, it was one of the biggest, fights in history. Would the Congress reauthorize it or not? He vetoed it. And so the Second Bank of the United States ended in 1836. So 2 tries, 2 failures. We had no central bank from 1836 to 1913. There was no central bank. And that was one of the, as you point out, Robert, one of the greatest periods of prosperity in American history. I mean, the telegraph, the telephone, the electricity, the automobile, I guess the airplane kind of came along at the tail end of that. Harvesters, machinery, ocean shipping, steam, you name railroads, you name it. I mean, we just grew and grew and grew from coast to coast, massively productive. Inflation was not a problem. Actually, deflation was a problem, but it was kind of the good kind of deflation where, when prices go down, if you make the same amount of money, you get a raise. You can buy more for your money. What's wrong with that when you think about it? So, and there were, you get guys who just sort of lost their way, like Paul Krugman said, but look at all the financial panics during the gold standard. It's like, yeah, I could list them, 1893, 1898, there were a lot of financial panics. By the way, look at all the financial panics without the gold standard. 1990, we had a serious recession. 1987, the stock market fell 22% one day. 1998, we came within an hour or so of shutting down every market in the world, and the LTCM crisis. 2000, the NASDAQ lost 80% after the dot-com bubble blew up. 2008, after the Lehman bankruptcy, again, the world was hanging by a thread. 2020, the economy, stock market collapsed, 30% in about 1 month, and there are many other crises, the tequila crisis, 1994, et cetera, et cetera. The point is, there are financial crises on a gold standard. There are financial crises when you're not on a gold standard. Guess what that tells me? As a statistician, you would say there's no correlation between gold and financial crises. Financial crises happen, but they don't happen because of gold, and otherwise gold works fine.
Something's happening in the silver market right now. Most people have no idea. Rich Dad does. For decades, silver was manipulated, suppressed, ignored, but something has changed. Silver is crushing the stock market. It isn't just outperforming, it's leaving everything else behind. Here's what most people missed. 2026 marks the 6th consecutive year the world uses more silver than it mines. Every electric vehicle runs on silver. Every solar panel runs on silver. Every AI data center running right now runs on silver. Bank of America forecasts silver could reach $309 an ounce. That's one of the largest banks in the world. Rich Dad's Robert Kiyosaki recently posted on X. He believes $100 in silver will be worth $500 within a year. Rich Dad also said, gold and silver are not investments, they are real money. Real money doesn't need hype. It doesn't need Wall Street's approval. History always catches up to it. That's why Rich Dad and Priority Gold created the free Rich Dad Guide to Silver. Everything Rich Dad knows about the metal most people are still sleeping on, and how to add real silver to your retirement, tax and penalty free. And when you request the free guide, you'll also receive Rich Dad's Playbook and the Rich Dad Wealth Defense Guide, 3 guides completely free. Visit richdadlovesgold.com for your free guides. Again, that's richdadlovesgold.com. Rich Dad figured out silver in 1965 when it cost pennies. Robert thinks $100 in silver today could be worth $500 within a year. The only question is this: when will you act? Visit richdadlovesgold.com for your free info kit now.
The stock market crashed in October 1929, but it bottomed in June 1932. That was a 3-year moving crash or rolling crash, whatever you want to call it, with some rallies along the way. And the total damage was over 80%, not 30%, not 40%, down 80%. And what people don't know is, you said, okay, then it rallied in 1933 and 1934. The Fed messed up again and blundered again, as they usually do, in 1937, and threw us into a double dip. But if you ask people, okay, well, everyone knows the stock market crashed in 1929. When did it regain those highs? How long did that take? The answer is 25 years. It was
1954.
It was 1954 before the market recovered from 1929. Now, it doesn't mean there weren't gains along the way, or you couldn't make money. You could. But if you say, oh, I'll just sit tight and wait till it comes back, well, a lot of people didn't live long enough. They didn't live 20. They never saw their money back because they didn't live 25 more years. So that's a real bear market. It's happened before. And so the point is, you need to be prepared for things like that. And no one alive, but very few people alive have seen anything like that. So that's I think that's the right framework to put it in. And if you say, well, what if we had another market crash right now? We'll talk about reasons why in a second. Why couldn't the Fed just come right back in and, print some more money and do the same thing over again and bail out the new failures, whoever they may be, whether it's, I call them Sam Bankman-Fraud, not Sam Bankman-Fried, but some people call him son of Sam Bankman-Fried, just
they're too young to know who son of Sam is.
Well, you can look it up. He's a serial killer, and this guy Sam Bankman-Fried is a serial killer of net worth. But you can just kind of keep bailing things out. Why not do it again? What's the big deal? Well, the answer is each bailout is bigger than the one before, and that's the point. You can go all the way back 1994 Mexico, 1998 Russia, LTCM, 2000 dot-com, 2008 Lehman, 2020 pandemic, and they do bail out, but each one's bigger than the one before. I mean, we threw out $7 trillion of new debt on top of a $1 trillion a year baseline, $7 trillion in new debt to kind of dig our way out of 2020. So there's a limit. There comes a time it's like, hey, this bailout is going to be 20 trillion. Sorry, that check's too big. We're going to have to let some things fail.
We talked about how the Fed is using what you call the equilibrium model,
right?
And you prefer the Bayesian model. Would you explain Bayesian model forecasting?
Sure. Bayesian statistics is a branch of statistics, and the main branch of statistics is called frequentis, just frequent. And basically says, give me more data. Data. The more data I have, the better prediction I can make.
That's the Fed.
That's the Fed. Well, that's the Fed, and actually most academics, but it's exactly what the Fed does. But what do you do when you don't have any data? What do you do when you have to solve a life or death problem and you only have maybe one data point instead of a million? And this is the problem we confronted at the CIA after 9/11. which is we had exactly one attack of this kind. Now, a frequentist would say, well, okay, let's wait until there are 30 more attacks and 100,000 dead, and then we'll have a nice database and we can work with it. But you don't have that luxury. These are life or death problems. These are existential problems. So what you do when you don't have enough data, you make an assumption anyway. You use intuition, you use the little data you have. If you actually say, I have nothing to go on, I have no idea what's going to happen, you make it 50-50. 50% chance this will happen, 50% chance it won't. But then as you go forward, more data comes in, and you apply the data to the assumption on a conditional basis, meaning what is the likelihood that the second thing would happen if the first thing were true or not true? And then you update. And so if the subsequent data tends to confirm one part of the hypothesis, you increase that probability. Maybe you go from 50 to 55 to 60, et cetera, or you decrease it. And this is the hard part, because you have to be willing to confront data that contradicts your hypothesis. If something comes in that says, no, you were wrong the first time, you have to be honest and lower those probabilities. And that's where a lot of times it falls down, because people, this is called confirmation bias. You reject the thing that disagrees with you and you accept the thing that agrees with you. Well, if you do that, you're pretty much going to be wrong. So you have to be humble, and you have to be able to take data that contradicts what you're saying. But if it tends to confirm what you're saying, then you increase the probability. And our friend Felix Sommery, we were talking about earlier, he left the University of Vienna, but instead of becoming an academic economist, he became a wealth manager and banker, moved to Switzerland, and he was very plugged in. He ran the Central Bank of Belgium. He was considered the leading expert on foreign exchange at the time, and maybe if he were alive today, he still would be. But so this is a picture, July 1914. It's weeks before World War I. But until then, people looked around and said, this is the most prosperous time in history. The weather in Europe was great that summer. The British Empire was at its height. Prosperity seemed everywhere. The fact that Serbia and Austria were having a little dust up didn't seem too significant. But Sommery had his antenna out, and he talked to a cousin of the King of England, who had just come back from meeting Kaiser Wilhelm, who was the emperor of Germany and the German Empire. And the other guy said to Sommery, he says, well, I've just come back from meeting with my cousin Willie. And he says the odds of war between England and Germany are zero, just not going to happen. But Sommery had more than an instinct. He knew that often the elites are the last to know. Everyone says, oh, you're rich, you're a billionaire, you're in the White House, you're, whatever it may be, Silicon Valley, you know more than anybody. It's usually not true. They are rich, I'll give them that. But and they're smart. I'm not detracting from that. But their predictive ability is very low. And the reason is they're in a bubble. I mean, if you're a billionaire and all you do is talk to other billionaires in a couple clubs in Silicon Valley or Washington or New York, you're actually not going to learn anything, because it's just an echo chamber. You've got to get out and kind of deal with real people and real situations. In the summer,
is that the Fed, and is that the
government? Kim, a very good question. They're all in a bubble. The Fed's in a bubble. The IMF's in a bubble. Silicon Valley billionaires are in a bubble. I'm not saying they're dumb, and they are rich, but they just hang out with other people like themselves. You're never going to learn anything if that's what you do.
People love to call real estate passive income, which is interesting because most of the investors I know are very busy finding deals, busy managing teams, busy worrying they picked the wrong market. Rent to Retirement flips the model. They help investors buy turnkey new construction homes, often 10% below market value in top rental markets across the country. Their local teams handle the build, the property management, and the details, so you don't have to. In some cases, investors receive 50 to 75% of their down payment back at closing, with interest as low as 3.75%.
I know everyone's talking about inflation. That's fine, but deflation is right around the corner, and no one's looking for it. Interest rates come down a lot. That means there could be huge capital gains on those notes, and of course, they're very high quality from a credit perspective. 10, 5, or 2-year notes, treasury notes, not junk bonds, but treasury notes in your portfolio. I have a big slice of cash, maybe as much as 30%. People say, I hate cash because it has no yield. Well, first of all, if we have deflation, cash could be your best performing asset, because the real value of money goes up, not down. It goes down in inflation, but it goes up in deflation. But cash also has embedded optionality, meaning if things are crashing and burning all around you, the person with cash who's not stuck in the wrong asset class can go shopping. You can pick up the bargains. And by the way, the biggest cash hoard in the world right now is probably Warren Buffett at Berkshire Hathaway. Has $130 billion in cash. Why? Because he sees what I see. He sees what we're talking about. The wreck is coming, and again, you get to go shopping. I like real estate. Not so much commercial real estate. I think it's early, but residential real estate, multifamily housing, farm, other kinds of income-producing real estate. That's a winner. I like gold, but 10%. People say, yeah, Jim Rickards says sell everything, buy gold. I've never said that. I don't think it's a good idea. But 10% slice gold and silver. By the way, silver will, in a real severe crisis or social disorder, a monster box, which is 501 ounce American silver eagles, costs maybe $15,000 or so at the market. That's like, to me, it's like having batteries and flashlight and water and plywood in a hurricane. You want a monster box around. And that's, by the way, that's real diversification. I run into people that've got 50 stocks and they say, I'm highly diversified. I've got 50 stocks in 10 sectors, semiconductors, minerals and mining, consumer non-durables. Like, if you're not diversified, you may have 50 stocks, but you're in one asset class, stocks. They're all going to go down together or they're all going to go up together. But when you have a slice of stocks, gold, silver, real estate, cash, treasury notes, and maybe some private equity, et cetera, that's real diversification, and that portfolio will get you through the storm. Well, the global money supply is about, I'm using M1 and the major economies, which is about 80% of global GDP, is about 33 trillion. And there happen to be about 34,000 tons of official gold. That's not all the gold in the world. That's the official gold held by central banks and so forth. Well, you just do the division. Okay, divide the 33. Take the 33 trillion, and just say you need 40% backing. Some people would say 100%, but historically 40% has worked pretty well. So you need about 12 or 13 trillion dollars worth of gold to back up that money. Well, if you have 34,000 tons and you need about 13 trillion dollars of gold to back up the money supply, what does that come to? We'll just divide by one by the other, and again, you get a number close to $14,000 an ounce. So there are two completely independent methods. One is the technical historical look. The other one is a monetary look based on money supply. But interestingly, they come out in the same place. And then there are other ways of getting to the same answer. So that's I feel very strong. I feel it's a very solid kind of analysis to get to that number. But the other part of your question, Robert, is, okay, what does it mean? Isn't this great? Well, gold's going up. I'm making a lot of money. Well, maybe you are, and other people are who have gold, and I certainly recommend it. But to me, the price of gold never changes. I think of gold by weight. You have an ounce, you have a kilo, you have a ton, you have a 400-ounce bar, whatever you may have. If the dollar price of gold is going up, what's really happening is that the value of the dollar is going down. Because gold is a constant store of value. So if all of a sudden, if $2,000 gets me an ounce, but we get to a world where it takes $5,000 to get me an ounce, what happened? The value of the dollar went down. I need 2.5 times more dollars to get the same ounce. So a high dollar price of gold is again, good for gold holders, but not close for celebration, because it means the complete and utter collapse of the US dollar. That's what happened in the 70s, and that's what's happening now.
And so then the next question is then, Buffett, who has really trashed gold for a long time, he also trashes Bitcoin. I think he called it rat poison or rat droppings. He called Bitcoin that. And I kind of laughed because he also said the same thing about Apple stocks. but Warren Buffett, he just started selling his banking shares, and he bought into Barrick. So from Jim Rickards' point of view, what do you think is going on in Buffett's mind?
Well, a couple of things. The reason for dumping the banking shares is, I was the counsel at Citibank for 10 years, so I know a little bit about the banking business. The way you make money is you borrow short and lend long. You borrow at a low rate and lend at a higher rate, and you keep the difference. You got fees and credit losses and lots of complications, but that's pretty much what the banking business has always been. Well, if interest rates are zero all across the yield curve, if you're borrowing close to zero, maybe 25 basis points, and you're lending close to zero, maybe 1% or less, how do you make money? The answer is you can't. You can make a little bit of money, you can leverage it a little bit, but you don't make enough money to cover your credit losses and your expenses and your overhead and fees and a lot of other costs associated with that. So the flatter the yield curve, here's a 10-year rate, here's a overnight rate. If it's like this, you can make all this money in between. You're taking risk in terms of timing, but you don't have to take a lot of credit risk. But if it's flat, you can't make any money. So he's dumping the banking shares because they can't make money. Why would you buy Barrick? Well, he obviously likes gold. That goes without saying. But Berkshire Hathaway, which is Buffett's investment vehicle, is so big. We're talking, upwards of $1 trillion. You can't buy junior miners. Junior miners can be very, very attractive investments, but they don't move the needle at Berkshire Hathaway. You got to be spending $500 million just to kind of get on the list. Well, there are only a couple of mining companies in the world that are that big. Newmont, Barrick, IAMGOLD, there are a few, but that's it. So Buffett's not going to be buying junior miners anywhere. He doesn't have the time and the ability to attract them. He needs a big name, and Barrick is one of the best. Interestingly, the way Barrick's going to make their money, they'll make money in gold for sure, and their stock price will go up, and it's a smart move by Buffett. But they're not going to make it by exploring. They're going to make it by buying junior miners. That's why for an investor a little bit smaller than Berkshire Hathaway, the junior miners can be attractive.
So Barrick will start buying junior miners. That's the
plan. They don't have the time to go out and explore and produce and take all that risk. They'll just wait until other people do, hit a good gold mine, prove it out, start mining, start producing, then they'll just buy that company and add it to their output.
This podcast is a presentation of Rich Dad Media Network.